Good day everyone, my name is Joric Laboy Menes and I am your reporter for today. And for today's discussion, we're going to tackle about the history of credit and the primary reasons why credit is offered. But before going to the main topic of this report, let us first have a quick discussion about the term credit and how we're going to define credit. We all know that this term is broad and have many different meanings in the financial world. But stated in the module, credit is a privilege granted by a creditor to a customer to defer the payment of a debt, to incur debt and defer its payment, or to purchase goods or services and defer payment. In layman's terms, it is generally defined as a contractual agreement between a lender and a borrower, in which a borrower receives something of value now and agrees to repay the lender at a later date, generally with interest. Now, let us proceed to our next topic about when and where credit started and how it works in the early stages of human history. Even before, in the early stages of human history, money and credit were unknown. Before these were discovered, people acquired and exchanged goods through a system called bartering or trading, which involves a direct trade of goods and services. But I will not further discuss this because I assume and I know that we've already tackled this in our previous subjects. The idea of exchanging goods and services in return for promise for future payment only developed after the century of trade. As early as 1300 BC, loans were made among the Babylonians and Assyrians on the security of mortgages and advanced deposits. By 1000 BC, the Babylonians had already devised a simple form of the bill of exchange, which involves three entities: the creditor, the debtor, and the third party. It's either a person, the creditor itself, or a bank. So, like for example, in this transaction, wherein the creditor merchant could direct the debtor merchant in a distant place to pay a third party to whom the first merchant was indebted. So, a quick trivia, in Babylonia, they have this Babylonian law or code wherein ang debtor kay pwede niya bayaran ng iyang utang gamit ang iyang property or services. So, like for example, if ang usa ka tao kay kailangan na kayo niya og kwarta, he is seized for debt and wala siya kabayad nga enough money sa iyang giutang, he or she could offer his service. It's either sa field, sa creditor, or even sa balay. And he can also pledge his property like house, field, or crop to pay his debt sa creditor. But the code stipulated that the debtor must take his crop himself, but he must also pay the creditor from its yield. So, in short, the whole property of the debtor might be pledged as a collateral for payment of a debt, without any of it passing through the hands of the creditor. So, these are the following traders in the Mediterranean area who also used credit: the Phoenicia, Greece, Rome, and Carthage. And because of the decline and fall of the Roman Empire, nahitabo nga division and disorganization sa ilang place. Mong isa sa reasons why they started to use credit bills of exchange and promissory notes para ma-reduce ang dangers and most especially ang difficulties sa pag-transfer sa money through unorganized trading areas. During the Middle Ages, a period which spanned 1,000 years from about 500 to 1,500 AD, credit bills were essential to the trading activities of the prosperous Italian city and states. During this period, the lending and borrowing have become widespread practices as well as the buying and selling on credit. Also, the debtor and creditor relationship was found in all classes of society, from peasants to nobles. During this time, there were two common forms of investment and credit, the sea loan and the fair letter. The first common form of investment and credit, especially in Italy, was the sea loan, whereby the capitalist advanced money to the merchant and thus shared the risk. So like for example, to pay for a cargo, ang usa ka merchant or ang usa ka ship owner magborrow og money for the duration of his voyage. And then, the loan and interest were then repaid out of the proceeds sa sale sa iyahang cargo. Only on condition nga dapat ang ship must return safely. But if in case ang ship kay mawala or malost, the creditor shall not be repaid and stood to lose the entire sum. Another form of credit was the fair letter, which was developed at fairs held regularly in the centers of the trading areas during the Middle Ages. The fair letter amounted to a promissory note to be paid before the end of the fair or at the time of the next fair. So generally, this fair letter usually used by merchants. A merchant is someone who works or owns a retail business and sells goods. This fair letter enables them to secure goods and credit, most especially if they don't have enough money or short of cash. This also gave the merchant time either to sell the goods brought to the fair or to take home and sell the goods that have been purchased on credit. After learning about the history of credit and how it works in the early stages of human history, now let us proceed to our next topic about the primary reasons why a company or a business offers credit to their customers. The primary reason for a company to offer credit terms to their customer is to accommodate the sale of goods and services in order to create revenue. So here are the following principal reasons why companies offer credit. Offering credit to customers can be challenging and risky, but on the other hand, this can also offer a major benefits to the company and business, as what discussed in the slides earlier. So that's it for today, guys. I hope you learned something about my report, and don't hesitate to chat me if you have further questions.
Good morning, BSBA. My topic is all about a credit process and the types of credit. So first, let us watch a short clip about credit.
Credit has three common meanings in the financial world. The first is a type of contractual agreement where a buyer borrows money to make a purchase and agrees to pay back the loan over time. This is called buying on credit. Credit cards are the most common example of buying on credit because consumers often do not have enough available cash on hand to make a purchase. Accepting credit cards greatly increases sales for retail or business-to-business sellers. In a similar usage of the word, credit can also mean the amount of money available to borrow. For example, the question, how much credit do you have, usually means how much money is available for you to borrow. If your credit card allows you to borrow up to $5,000, this would be the answer. Credit is also an accounting term. On a balance sheet, a credit is an entry depicting an action that either decreased assets or increased liabilities. On an income statement, a credit will increase net income. In each of these situations, debit is the term used for the opposite type of accounting entry.
So, credit is generally defined as an agreement between a lender and a borrower who promise to repay a seller with a later date. So, ito namang si process is just like a step-by-step na paraan. At kung ipagdugtungan natin, credit process, in a simple terms, begin with the buyer and who decide to purchase a product from a seller. Either a seller provides goods and services, and of course, buyers must have medium of exchange, just like cash, that most is readily accepted. In the modules, may apat na proseso. Una, sales make contact and order is taken. Credit department reviews customer for credit worthiness. Credit worthiness means the purchaser ability to obtain a product or services on its promise to pay at a later date, called credit worthiness. And third, goods and services delivered on credit. Fourth, payment is made in on time or within terms. So, for example, in a lending company, ipagpalagay natin na si Mr. Joric Jimenez ay isang manager ng Pag-asa Lending Company. At ako naman ay isang bilang mangungutang ng kanilang kumpanya. Nag-apply ako ng loan, syempre, hindi kanila agad bibigyan. Dahil, kailangan nilang i-review yung papers mo at i-check yung background mo kung you are qualified enough to get a loan. If it is okay, syempre, tataas yung revenue nila kapag nakuha mo na. So, the transaction would be recorded as account receivable for Jaric and accounts payable for me. So, on that day, the agreement would be discussed if the payment is within days, weeks, or within terms. So, yung apat na nakasulat sa modules natin ay isang summary ng proseso upang mas madaling maintindihan nating mga mag-aaral. And then next, we have operating cycle. Question: is it possible that a manufacturer can be a debtor or a creditor? If yes, and if no, here I go. Operating cycle can be defined as the period of time between the acquisition of material, labor, and overhead inputs for production and the collection of sales receipts. As you can see in the figure 1.1, explain that a manufacturer can be both a debtor and a creditor. Let's consider a typical operating cycle for a manufacturer. The purchaser of raw material is usually a business credit transaction. The material is converted into goods during the production stage, and the manufacturer must pay its supplier for the materials. And then, manufacturer sells the finished goods to a customer. So, the purchaser becomes the debtor or the user of credit, while the seller becomes the creditor or the grantor of credit. Then, next we have figure 1.2. In the connection with my example a while ago, that if you apply a credit transaction, there was a 50-50 chance either you are rejected or accepted. And if you are rejected, the seller ay magbigay siya ng bagong termino. Then, the seller made credit investigation and after that, the buyer now ay tinatawag na debtor. If non-credit transaction, much easier. Again, let me show you a short last clip regarding trade credit. By the way, trade credit is a type of commercial financing in which a customer is allowed to purchase goods or services and pay the supplier at a later scheduled date.
Trade credit means that a customer purchases goods from a seller who allows the purchaser to pay for those goods at a later time. In essence, the seller is making a short-term loan to the purchaser. Typical trade credit terms are 30 days to pay, but it can also be 45, 60, 90, or in some cases, 180 days. Purchasers who are given more than 30-day terms generally have a stronger bargaining position than the seller. Big box retailers such as Walmart often will not buy products from suppliers without 60-day trade credit terms. Also, some sellers will set trade credit terms to entice purchasers to pay early by offering a discount if the purchaser pays within 10 days. A famous example of how trade credit is used involves Steve Jobs and Steve Wozniak and the first sale of the Apple computer. Jobs had an order for 50 assembled computers from a local computer store called the Byte Shop. He took the order to Apple's computer parts supplier and negotiated trade credit of 30-day terms. He then ordered enough parts for 100 computers. Apple assembled and delivered 50 computers to the Byte Shop, which then paid for the computers on delivery. Jobs used the money to pay the parts supplier's invoice, leaving Apple with the additional parts for 50 more computers free and clear. Apple assembled those parts into 50 more computers and sold them for a profit.
So my last topic is all about the types of credit. So since credit is used in a different ways, so it broadly classified as public and a private credit. Public credit, also known as government credit. This would only apply for any agencies or any government unit or divisions. For example, to finance schools, highways, health and social welfare, and military preparedness. The government also purchases a wealth of products and services, just like tanks, foods, planes, books, and office supplies, and etc. More and more, in order to provide their or his community. Isa sa mga halimbawa nito ay yung mga TS scholar at saka yung mga guro na galing public because their salaries are given by the government. Private credits is extended to or used by individuals or business to carry on the exchange of goods and services in the private sector. So these private credits are divided into 5 categories. Ito po yung 5 kategorya ng private credits. Una, investment credit. Ito po yung kadalasang inutang na may pakialam sa kanyang bayan, tulad ng pagpapatayo ng paaralan at pagpapakumpleto ng sa kanilang daan. Pangalawa is ang consumer credit. It is defined as credit extended to a natural person, primarily for personal, family, or household purposes. Third is agricultural credit. These types of financing are adapted to the specific financial needs of agricultural operation, gaya ng sa harvesting at saka mga materials or equipments na kinakailangan sa magsasaka. Fourth is business credit. Refers to extensions of credit primarily for business or commercial purposes. It is often referred to as business-to-business credit. Fourth is the bank credit. It is an agreement between bank and borrowers where banks make loans to borrowers. In other words, banks to banks transactions. So that's all. I hope you learn. And with or without experience having a loan, it can use that we need also know how to apply or what we are going to apply upang hindi tayo mabaguhan sa mga ganito. Thank you.
Good morning, everyone. So as discussed with the previous reporter about the primary reasons to offer credit and the brief history of credit, and now we are down to the elements of credit and the 5 C's of credit. Basically, credit is a privilege granted by a creditor to a customer to defer payment or to purchase goods or services and defer payment. Second, credit defined as an agreement between a lender and a borrower who promises to repay then at a later date, generally with an interest. Credit is derived from the Latin word credere, which is to believe or to trust.
The elements of credit are: these are the 5 C's of credit.
So you're thinking about expanding your business with new equipment. You know you want to finance your machines, and you're curious, how do lenders decide how much they'll lend me, and how do they establish my terms? Well, to put it simply, they take a look at your 5 C's of credit: capacity, capital, collateral, conditions, and character. First, let's take a look at capacity. Capacity is your ability to repay your loan. So it's no surprise that it's the most important C of all. To determine your capacity, lenders look at how much cash you have and how you intend to repay the loan. Cash flow and sources of repayment are the main factors in establishing capacity. Capital is the money you have invested in your business. The amount you invest in your business before approaching a lender can enhance your capital and qualify you for more flexible loan terms. Providing lenders with detailed cash flow projections and information about your business plan may also help you get the terms you're looking for. Next up is collateral. Collateral guarantees another personal asset as a source of repayment if you can't repay your loan otherwise. The equipment you are financing is the most common form of collateral. Sometimes it's also beneficial to have a cosigner guarantee to repay the loan if something were to happen. Conditions describe the circumstances affecting your loan. For instance, are you buying new equipment while wanting to have extra capital on hand for growth? How big will your down payment be? And what kind of loan structure are you applying for? Conditions also describe economic, legal, and regulatory circumstances in related industries that could affect your business. Last is character, or how you come off to your lender. How long you've been in business, payment on prior loans, and your relationship with the lender all say a lot about your character. Now is the time to examine your capacity, capital, collateral, conditions, and character to determine how you can improve your credit assessment. Be sure to be upfront with your lender if one or more of your 5 C's needs improvement. By providing high-quality, complete information, you already prove a level of responsibility and transparency. Many lenders are happy to work with you to give you the loan you need.